Could the Federal Reserve actually cut the Fed rate in 2024? Well, that's what we're going to cover in today's video. The past couple of months have yielded a slew of economic data points demonstrating a slowing economy, which we know is what the Fed has been waiting for. But could it be too late? And how will a 2024 Fed rate cut impact home buyers and sellers? Hey there, I'm Nicole Ruth, SVP and mortgage originator of over 22 years and proud economic geek. If you dig content on the real estate, mortgage, and home buying market, make sure to hit that thumbs up button and subscribe to my channel so you always get up to date on the latest housing trends. If you're ready, let's jump into it. I am constantly asked, when will mortgage rates come down? Affordability is the topic of the day, and that helps everyone. And while a change in the Fed rate does not directly equal changes to mortgage rates, there is a strong correlation between the two. And given recent economic data, we may see a Fed rate cut sooner than I anticipated, as I was pretty confident in a March 2025 rate cut, given how resilient the market was staying. Let's consider some recent data that's changed all of that. Data which is signaling signs of a slowing economy, maybe even a recession. Then I'll highlight what the Fed Chair Powell has said in a response to the recent data and why dropping the Fed rate could actually yield declining mortgage rates. And then there's a bonus. Make sure to stick around to the end, because I'm also going to give you some key guidance if you're planning to buy or sell a home within the next 8 to 12 months that could literally save you a ton of time and money. Last week, we saw a break in the labor market, one we've all been waiting for, along with the unofficial execution of the SOM rule, with the June unemployment rate coming in at 4.1%. Economist Claudia Sahm designed the SOM rule to help pinpoint when a recession begins by using the average of the 3 most recent months of unemployment and comparing it to the lowest measure taken during the last rolling 12 months. When the 3-month average hits a 0.5% higher than the low point, you guessed it, the economy is in a recession. With June hitting 4.1%, May at 4%, and April at 3.9%, we're at a 0.5% higher than the 3.5% low in July of 2023. However, when taking into account 2 decimals, we officially landed at 0.43% higher. So some are calling the recession. Others are looking to July to make the call. Either way, next month's unemployment will be pivotal. There were also 206,000 jobs created in June, reported the first week of July. While slightly higher than the 200,000 expected, it showed the job market's continued slowing trend. Total jobs in the United States increased 1.7% over last year, which is the lowest year-over-year growth since March of 2021. Then there's the revisions. The Bureau of Labor Statistics, or the BLS, revised down April and May's reported job numbers by a whopping 110,000. That's a lot. The average hourly earnings also slowed down, increasing 3.9% over last year. This is the slowest growth rate since May of 2021. Friday's jobs and unemployment report was critical timing, given Fed Chair Powell's testimony on Capitol Hill this week. And of course, as we know, his focus has been on the labor market. And Claudia Sahm nailed it when she said, when workers lose their paychecks, they cut back on spending. We're all feeling that. And as businesses lose customers, they need fewer workers, and so on. Once this feedback loop starts, it's usually self-reinforcing and accelerates. Now, Powell expressed concern to the Senate that holding interest rates too high for too long could jeopardize economic growth, and that during the second quarter of 2024, the monthly inflation numbers have actually shown further progress towards their 2% inflation goal. In fact, the Fed's preferred measure of inflation, the core PCE, moved down to 2.6% in May. That's the lowest it's been since March of 2021. So I ask, is economic growth already jeopardized? And then there's housing. Housing market just experienced a 6-month low in new home sales. June's existing home sales look more like 2010 than 2024. And building starts are their lowest they've been in 4 years. Manufacturing and services economy is also weakening. The ISM manufacturing PMI has been in contraction for 19 of the last 20 months. The only 2 times that this has happened before was leading up to the recession of 1990 and 1981. ISM services just took a dive on Friday with June's report, coming in at the lowest level since May of 2020, and then you have to go back to 2008. The only time both the manufacturing and services sector of the United States were both in contraction was the 2008 recession and the 2020 recession. The Atlanta Fed is now projecting a small 1.5% for real GDP in the second quarter. This is down from 3% just a few weeks ago. All of this weakness has investors betting on 2 rate cuts in 2024, with a 77% probability the first cut will happen in September and an 87% probability that the first rate cut will happen in November, with most agreeing that a second rate cut is considered a slam dunk in December. Powell also noted during his time on Capitol Hill that easing too soon or too much could harm inflation progress. But I ask, can he wait any longer? It's a delicate balance, given the weakness in both manufacturing and services, the softness in the labor market, and the rise in unemployment. I'm starting to see a case for a 2024 rate cut. When that rate cut happens, whether it's 2024 or early 2025, it will not make mortgage rates go down, technically. Technically, there is no relationship between the Fed rate and the long-term bond yields. However, the slowing economy is affecting both. And more than anything else, investor confidence is waiting with bated breath for some relief from this higher for longer rate cycle. When the Fed rate starts its descent, investors will rally and demand will move towards bonds, pushing up bond prices and lowering their yield, aka our rates. So time for that bonus I was telling you about. So what does a lower Fed rate, lower mortgage rates, and today's current market conditions mean to buyers in today's market who are waiting for either prices or rates to come down? Home prices hit their peak in May 2022. They've been soft and somewhat flat since then. If you look at Denver's home price index, we are 3.5% under our peak. If you look a little broader at the Denver Metro, we're under 1% beneath our peak. And then if you expand it out to the United States, we are continuing to hit record high home prices. If you were waiting for home prices to drop and you're in the Denver market, it already happened. As for rates, if you believe a rate cut is possible in 2024, mortgage rates will come down as the investors celebrate and buyers reappear. I'm not a fan of pushing anyone to buy because this is such a personal decision. But I am keen on identifying opportunities, and the signs are starting to show when the ball might hit the ground. Today's higher inventory, fewer buyers, and higher interest rates can confidently convince you to wait, as it feels unsafe. However, overvalued houses can get more overvalued, and homes can be permanently more expensive. If that's the case, more inventory is more choices. Fewer buyers means more negotiating opportunity. And higher rates, while high, allow you to lock in against inflation and rising rents. If buying before lower rates bring in more buyers and more competitiveness and higher home prices, If that's appealing to you, or at least worth a conversation, now might be the perfect time to have it, knowing that the odds for a 2024 Fed rate cut are growing. More of what Powell and the Fed board is thinking will be revealed at their July 30th and 31st Fed meeting, where we are expecting no rate cuts, but waiting for the words he brings during his speech and Q&A after. If you want even more housing market insights as a home buyer or seller in 2024, be sure to check out the video I have linked in the screen now so you can make more informed decisions in today's housing market. And I'll look forward to seeing you soon.